We'll talk about our objectives for today. It's always good to have objectives. And we would like to really summarize some of the reporting frameworks that apply to private companies in particular, and U.S. private companies specifically. Mike spent a lot of time on the international perspective. We're going to bring it back to the U.S. We want to highlight recent changes in U.S. GAAP, and we want to talk about likely changes or potential changes going forward. And Eric and I will split that up, and as Rick mentioned, be available for questions or comments really throughout the day. We will not seek to discuss auditing standards or the new SARs. We'll also stay away from IFRS, the international standards. We'll stay away from the SEC and PCAOB matters. And we'll stay away from certain industries that have very specific reporting requirements or rules that we didn't believe were broadly applicable to private or closely held businesses. We'll talk a little bit about the reporting frameworks, and while we've covered this before, it's sort of important to remember because that sets the stage for what we're talking about, whether we're talking IFRS, IFRS SME, the AICPA1, US GAAP, Private Company Counsel, and so on. What are all these reporting frameworks? Well, there are an ever-increasing number of them. The most important ones, in our view, are probably deservedly at the top is US GAAP. We believe that US GAAP will remain really the de facto standard for most companies of size operating as private businesses in the United States. That will be enhanced by options that come out of the Private Company Council, the private company decision-making framework that was established a few years ago. And the PCC has been a little bit active in the last couple of years, and we'll see some of their issuances a little bit later this morning. International standards are clearly important. Many, many countries, an overwhelming majority of countries have adopted IFRS, including both of our neighbors to the north and to the south. But the United States has adopted more of an approach of convergence than adoption. IFRS for SMEs was released with a lot of hype 5 years ago or so, and really didn't catch on nearly as much as I think as some of the standard setters thought. It's kind of the private company framework for IFRS. You'll see it in Canada. I think Mexico has voted not to accept it, but don't hold me to that. But it's out there. We also have the reporting framework from the AICPA that came out a short while ago, and many other special purpose frameworks that we'll touch on. It's important to note that each of these can be acceptable frameworks upon which financial statements can be issued and upon which an accounting firm can issue an audit report or a review report. What is this FRF for SMEs? This is the AICPA's attempt to really kind of jump into this fray in 2013. It's short. It's very concise, 206 pages. And I have to clarify that. It's not just 206 pages. It's 206 pages at a font size that I can read, which means it's probably really about 150 pages. So it's extremely concise. It was intended to be a new option for small, medium-sized translate private entities. And it must be significantly less complex than US GAAP because look how short it is. I mean, we have the revenue recognition standard that Erika is going to talk about is longer than the entire framework in this case. So it is significantly less complex, and it should really strive to provide a historical basis. It basically abandons this 20-year move towards fair value accounting and kind of moves back to a very basic cost basis approach to reporting. It is considered, in fact, a special purpose framework. We'll have another comment or two about that. We won't go into all the differences because we're going to talk about sort of limited applicability for it, at least in our bias. But a couple of things just to highlight the essence of it, and I think you'll get the flavor from this, is that Goodwill is amortized consistent with tax treatment. Not consistent with the other GAAP, not consistent with the PCC options that are available that we'll talk about. Goodwill is amortized consistent with tax treatment and over 10 years if Goodwill is not amortized for tax, so otherwise 15. There's no VIE consolidation. They basically say that whole concept VIE never happened for this framework. Lease treatment, again, is similar to tax treatment. That'll become more lovely because we'll talk about the new lease pronouncement in a short while. But the lease presentation will really follow the tax presentation rather than the GAAP presentation. Swaps, fair value reporting, they're not there. And as you would expect, because we're not doing a lot of these things that would yield more complex disclosure, the disclosure is very, very simple and much, much simplified. We think it has a limited applicability. This is a biased, not an objective statement. Much of what Eric and I say today are objective conveyance of information. This is much more of a bias. We think it has limited availability for for-profit owner-managed entities. It's interesting to note that for other constituencies, I think they would have a problem with the extreme simplicity of this, the lack of disclosure, the fact that there is no technical oversight. So this is not there is no authoritative standard setter here. It is another comprehensive basis like the cash basis or some other things. But nevertheless, as I mentioned before, CPAs can provide audit review or compilation reports. The new SARs allow you to do compilation-like reports on a broad number of things, so I will usually just focus on the audit and the review side of it. Other special purpose frameworks that are becoming increasingly popular in certain circles include the modified cash basis, income tax basis, and different regulatory or contractual bases of accounting. The cash basis, while it's still out there, we don't see used once a company has some depth or breadth. But we have a client who's approaching $1 billion in assets that uses the modified cash basis. Suits their purposes. We see an increasing comfort in using some of these other bases of accounting where it makes sense. You've always seen a lot of the contractual bases and regulatory bases in particular situations, but they have now been, a couple of years ago, really codified or really stated as acceptable for financial reporting purposes. So who are these standard setters, since I said that the AICPA framework didn't have one? Who makes the rules? Knowing who makes the rules sometimes helps to understand the rules. Knowing who we're not going to talk about also understands the bias of our presentation this morning. Well, the basic standard setters working from the bottom up are the IASB for the international standards. We already said we're not talking about them. 2 up from the bottom, the GASB. We're not talking about the government stuff. And the Private Company Council and the FASB, which are who we're going to focus on, who really function to build US GAAP. It's interesting to note that the top 3 are really subsidiaries of the same parent. There's no authoritative line between the FASB and the PCC. The FASB does not have authority over the PCC or the other way around, or the GASB. They're all common subsidiaries of the FAF, or the Financial Accounting Foundation. So that's important to note. With regard to recent changes to GAAP, Erika's going to walk us through several and then invite me back into the conversation.
Okay, great. I am going to go ahead and walk us through 9 accounting standards updates, which were issued by the FASB fairly recently, and then 1 change to the auditing standards that is a little bit older than that. So beginning with ASU 2015-14, that actually came out pretty recently, August of 2015. You'll see from the slide, it's deferring the effective date of the revenue recognition standard that Jeff has already touched on a little bit and that he and I will be co-presenting on later in the presentation. So you'll see from the slide that if you are a non-public company and you are on a calendar year, fiscal 2019 is going to be the first one where you are implementing this change. One thing I think it's important to keep in mind here is that this doesn't just mean, oh, I'm just not going to have this on my radar anymore for another year. Yay, the effective date is deferred. What it really means is that the FASB expects that it's going to take some additional time to implement this type of guidance, and that depending on the type of company you're in, it might take some efforts between the accounting team, finance, and sales to make sure that contracts are written the way that you want in order to recognize revenue in the way that you're hoping for. ASU 2015-01, it eliminates the concept of extraordinary items. So extraordinary items had been defined as both unusual in nature and infrequent in occurrence. And what was happening is that the definitions for these were so stringent that very few things were actually ending up in the income statement as extraordinary items. So the concept here is eliminated going forward, and you'll see the effective date there on the slide. Okay, ASU 2015-02, that deals with the consolidation topic, and that can get pretty complex. I'm really only going to touch on 2 of the principles under there. First of all, under previous guidance, there was a presumption that if you're a general partner, you are going to consolidate a limited partnership. Now, of course, that could be overridden by a few different things, but for the most part, that was what happened. So this ASU goes ahead and eliminates that presumption. Secondly, the VIE analysis in the decision tree there is somewhat modified, and especially relating to certain fee arrangements and related parties. And really the impact of this is that fewer entities are going to be consolidated as variable interest entities under this guidance. Okay, moving into internal use software. So prior to this, the FASB had not really included any guidance on cloud computing arrangements in the codification. So some examples of cloud computing arrangements would include software as a service, platform as a service, other hosting arrangements. So what this guidance is trying to help us determine is whether these types of arrangements include a software license or not. And basically, if a software license is included in the arrangements, then you're going to capitalize these fees, typically as intangible assets, and amortize them over the life of the software license. If it's found that the arrangement does not include a software license, in general, these fees are going to be expensed.
Just to add two thoughts, if I might. I think they did a good job on this one of tracking the other side and the new revenue recognition standard for the software component and how licenses are recognized. But the essence of it is that no change to service contracts, but that one has to kind of dig into your contract with NetSuite or Salesforce or Acumatica, whomever it is, and look at the elements of that contract to determine if there's a license as a component of that arrangement.
Okay, moving on to ASU 2015-07. So this impacts the fair value measurement topic, but really only a specific subset of it, and that would be investments that are reported using net asset value or NAV. And it's really only some of the investments that are reported at NAV. But these specific types of investments will be removed from the fair value hierarchy going forward. So the fair value hierarchy, probably many of you are familiar, is where investments are leveled as 1, 2, or 3, disclosed in the footnotes to the financial statements. So there are certain NAV investments, typically your more alternative investments that would have been treated as a level 2 or level 3, that will now no longer be reported within that hierarchy. Okay, ASU 2015-03 relates to debt issuance costs. You might also know these as deferred financing charges. So currently, deferred financing charges are reported as assets on the balance sheet, and they're typically over time amortized over the term of the related debt liability. But there is a problem with this conceptually. It was pointed out that really recognizing these as assets or reporting these as assets isn't really accurate because there's no future economic benefit being provided to the entity, which is part of your conceptual definition of an asset. So resulting from this ASU, now those deferred financing charges are going to be presented as a direct deduction from the carrying amount of the related debt. So not assets, you could think of them almost as contra liabilities on the balance sheet. And you are going to have some flexibility in terms of, are we going to net these on the face of the balance sheet and then break them out in the footnotes, or show more detail on the face? There are a couple of options out there for you on those. Okay, discontinued operations, ASU 2014-08. So another general comment that was made by users of the financial statements was that, you know what, there are just too many things being reported as discontinued operations. Maybe the disposal was only of a small group of assets, or maybe these types of disposals happen frequently, so I'm seeing them in financial statements all the time. So what they're really doing through this ASU is raising the bar in terms of what is considered a discontinued operation. So you'll see here on the slide, if the disposal represents a strategic shift that has or will have a major effect on the entity, that's when that discontinued operation presentation is still used. So an example would be if you are disposing of a whole product line or of a whole geographical area where you operated, that would still trigger that type of reporting. If that type of reporting is still triggered, there are now more robust disclosures that are needed to report and disclose these for the readers. ASU 2014-10 relates to development stage entities. So how were development stage entities previously defined? They were defined as entities devoting substantially all efforts to establishing a new business, and either planned principal operations had not commenced, or they had commenced but not produced significant revenue yet. So what ended up happening here is that, again, users of the financial statements were telling the FASB, you know what, this really isn't a useful distinction, and these additional reporting requirements that go along with this really aren't that relevant, aren't that helpful to users. Specifically, there are some inception to date disclosures that were required that now have been eliminated because the definition of development stage entity is no longer even in the master glossary to the codification. Okay, so my final ASU that I'm going to go over is ASU 2014-15, which relates to going concern. So prior to this, there had been several pieces of guidance in auditing standards relating to going concern. This is the first time you're seeing this concept showing up in the accounting standards. And basically now management is required to evaluate going concern. And the period of time for that evaluation is a little bit different than what's currently housed in the auditing standards. It's 1 year after the date the financial statements are issued. The difference being that under auditing standards, we're looking at typically 1 year after the balance sheet date. So there's talk that the auditing standards are now going to be revised to conform with what's in the accounting standards. But right now, this is something to keep on the radar as management, that this is something that you should be evaluating. Okay, keeping you on your toes a little bit, throwing in an auditing standard. This actually is from 2012, but there's still some misunderstanding regarding its application. Basically, what this is saying is that an auditor is permitted to have a clean or unmodified opinion on financial statements that are prepared in accordance with generally accepted accounting standards in a different country. So even if a different country's GAAP is used, you can still, as an auditor, have an unmodified or clean opinion. However, you should have some sort of emphasis of a matter paragraph to highlight what foreign reporting framework is being used. And I think now Jeff's going to pick up and discuss the next
I think
few
you'll notice a
ASUs.
theme from Erika's discussion, that there's a lot of simplification. I think that you'll see fewer complex definitions, unusual and frequent, development stage, enterprise, and so on. And that theme will continue through a lot of the exposure drafts and some of the things we'll talk about now, except for the two big ones at the end, the leases and the revenue recognition. And I was thinking about the applicability of that and how people are impacted. And I think that for businesses, it probably is helpful. We are very pleased to have several accounting professors from local colleges and universities with us this morning, and I recognize it's a hardship for them because entire sections of the exams now have to be taken out. All those trick questions about unusual and infrequent and inception to date, equity and income statement information now have to be stricken, and new questions probably related to the 5 steps of revenue recognition are inserted. But continuing the simplification theme, that's even moved into benefit plan accounting. And there are a handful of things that are really pretty fascinating here. The first, more narrowly applicable, but for those plans that have guaranteed investment contracts or GICs that are fully benefit responsive. And many of you who are FASB fanatics would recognize that there's a lot of different disclosure for fully benefit responsive contracts and those that are not. But one of the challenges has been how to do the fair value accounting for a fully benefit responsive GIC, for example. And in practice, there was a lot of disparity between the net asset value, which was the comfortable way to present it, and the fair value, which was the GAAP requirement. Usually they weren't so far apart that a plan would do one or the other, maybe have a reconciliation on the face or disclosed or passed upon. But now we can just go right to contract value rather than fair value. So that's quite helpful. Another one in that simplification theme that's being removed is the 5% or more disclosure. I think the standard setters have looked at the benefit plan statements and saying our problems to users or our challenges to users really are not solved by or helped by knowing which particular investments are more than 5%. because one's 6%, another's 4%, it doesn't really change users. So the 5% disclosure goes away. Some plans, particularly as investment mixes became more complex, where you had more alternative investments mixed in, along with certain things that were subject to hierarchy, some that were not, you had these 2- and 3-page sets of different matrices, different tables that outlined the investments and the performance thereon by various different types. Now we'll be able to disclose those just by general type, including the grouping of the investments, but also the investment performance. These are effective imminently, so that can be very helpful to many who have benefit plans that have these reporting issues. Moving to the private company counsel, we group these together rather than earlier because these don't apply to everybody. They apply only to private companies as defined in the literature. And secondly, they're not automatically applicable to a private company. A private company has to essentially choose the private company alternative. The main Gaap alternative is always the default position for a private company, but they now have the option to make use of the standards issued by the private company counsel. And there are a handful. Some of them are really helpful, and that's where we'll go back a little bit longer, including this one that was issued in early 2014, and that was an alternative for amortization of goodwill. So we now get away from the impairment test for goodwill, the indefinite life. We can still do it if we want. They simplified the impairment stuff. We talked about that a year or two ago. But now, if we can amortize goodwill over 10 years, then we only have to do the impairment test when there's a triggering event, very similar to failing the qualitative test in the main Gaap impairment testing literature. And very helpfully to a private entity, we can do this impairment test at the entity-wide level rather than the sometimes complex definition of reporting unit level that applies for primary US GAAP. Additionally, we have some simplification on interest rate swaps. I think it was very obvious that the majority of swaps for private companies were fixed to variable to fixed interest rate swaps on debt. So now there's a simplified accounting and reporting process for that. But there are many exclusions. So before choosing this, make sure that you don't fall under one of the exclusions. And a lot of the exclusions will apply to a lot of reasonably sophisticated private companies. If you have forward starting dates, so maybe your debt started a year ago, but your swap starts 2 years from now because you're really good at predicting when the Fed really is going to raise rates, or anything along those lines, which again are quite common, or disparate terms. Remember, these things have to line up well to get the simplified reporting. But if you have disparate terms between the swap and the debt, if you have forward starting dates, which are extremely common, then you're really under one of the exclusions, and you have to go with the main Gaap rather than the simplified opportunity. Erika talked about one of the VIE options for general partners not being presumptively consolidated. This is another VIE issue that's extremely helpful to private companies that had real estate entities. So maybe Erika Incorporated ran a little manufacturing and distribution company, and Erika also built and owned the building in which that company operated and leased it to that company. Well, that kind of threw these private companies into this VIE analysis. And the PCC said, where it's just exceedingly simple, where Erika builds the building for Erika Inc., the primary activities of Erika Leasing or Erika Real Estate are interacting with Erika Inc., and there really aren't other business transactions between the two. Erika Real Estate isn't marketing the product and so on and so forth. We really don't have to do this consolidation, this detailed VIE analysis. Merely don't consolidate it, and then do a fair amount of disclosures. There are the typical required disclosures that really cover not only what you normally see for leases, but also the related parties. And that makes sense. This is kind of back to the future on these, where you would disclose the lease terms, the relationships, the relevant debt, if there's cross-collateralization, some different things kick in. And it becomes very convenient. But remember, if you don't fall into these narrow guidelines, you still need to apply all of the VIE tests that would normally be there under the old FIN 46R and the other accounting ASUs that have impacted it since it was issued. One that's, I think, going to be helpful to a lot of private businesses that are acquisitive, or even those that are acquired, is this one regarding business combinations. there are now some options for dealing with what's been a burden to private companies. Going out, and while we really enjoy and appreciate the opportunity to value an organization once a transaction happens, I think the private company world recognized that that's not quite as valuable for a private company as it might be for somebody else. Very few private companies have an intangible asset the equivalent of the recipe for Coca-Cola, or the logo for Frito-Lay, or whatever those intangibles might often be. So the private companies are given an option in business combinations, purchase accounting situations, to choose an alternative. This is a narrow path you have to navigate here as well. You have to choose the Goodwill alternative that we talked about a few moments ago, the 10-year amortization of Goodwill. That's not so hard in most cases for these companies. But then the intangibles that are limited to customer-related intangibles. To the extent that the only material intangibles being acquired are customer-related, then this can be applicable. What are customer-related intangibles in non-competition arrangements? They tend to be customer lists, customer relationships. And in addition, when you combine those with the non-competition agreements, you really cover a majority of the transactions in the few million to maybe a couple $100 million transaction space. So I think it's expected that quite a few private companies will give a pretty strong thought to this. Now remember, because it's limited to customer-related intangibles, if you do have patents, if you do have trademarks, if you do have the recipe for Coca-Cola, then you do fall back into all of the requirements that have existed for several years now regarding business combinations and the valuation of separately identifiable intangibles. Let's talk about some potential changes to US GAAP and the fact that the FASB sought to foil my plans today by voting on something yesterday. So we'll get to that in a minute or two. We want to really focus on those things that we think will impact private companies and with the largest overall impact. So once again, we talk about what we're focusing on. And a lot of them really are joint projects between the FASB and the IASB. We've seen significant convergence over the last several years. It's likely we'll see continuing convergence, and we'll see that when we talk about the lease statement. So one of the easiest ones to talk about is this exposure draft that relates to revenue recognition, because there's a whole bunch of them out there. Even though Erika is going to be talking about the pronouncement that was issued in May of 2014, there will always be, or there seems to be, a lot of intent to tweak that and keep our eye on the exposure drafts that relate to adoption of revenue recognition. And back to the simplification theme, there are exposure drafts existing now, either in the comment period or shortly after the comment period, that really address simplification of share-based payments. Some of you still think of that as 123R, but when you have appreciation rights, stock options, any number of things along those lines, that disclosure and the valuation requirements and so on have become sometimes more complex than is perhaps helpful for an early stage entity. And the technology companies and other early stage entities are those who are probably most often impacted by this. But the exposure draft would move to bring a bit of simplification and clarity to the share-based payment side of disclosure, reporting and disclosure. Certain equity method and joint venture accounting matters. For 20-some years, the profession has recognized the need to bring more clarity to a couple of areas. Joint venture have been one of them. Secondly, when you're dealing with entities under common control has been another of them. And sometimes the definition of common control is a little murkier in a joint venture agreement, and many real estate or development-related companies will be touched deeply by that, and there are even separate rules for them. So probably 20 years after the intended start date, an exposure draft has been issued. The comment period ended in August. That really relates to accounting for equity investments in joint ventures and other matters. And I think it's fair to expect that we'll see more joint venture-related exposure drafts in the coming years to bring some long overdue clarity there. One that I don't understand, although I might be the only one who doesn't that views it this way, is there has been a sense that deferred tax reporting needs to be simplified. I have this fear that they're going to dust off the old FAS 96, which was horrific, and bring it back out of retirement and say that that achieved their goal. Because I'm not sure that I saw the vast improvement. I understand the balance sheet perspective and so on, moving from APB 11 to FAS 109, but it seems to me that deferred taxes make sense. But since no one else in the standard setter community agrees with that, we do have an exposure draft that would simplify deferred tax reporting and probably look for that to actually be acted upon as one of the more highly likely ASUs to come out in 2016 sometime. There are always a few related to fair value, derivatives, and hedging, because oftentimes they're technical corrections, but anytime you're dealing in a complex area like this, as soon as you issue something, you really don't anticipate all the unintended consequences, so let's go back and let's deal with some unintended consequences, or let's make it applicable to something else that has now come up in financial society. There's a move towards improving footnote disclosures. This one I do agree with, how to make footnotes more clear and understandable to a non-CPA reader. I think that's a very worthy goal. And there are several exposure drafts, or a handful, that really relate to bringing more understandability to footnote disclosures. One that was touched on, I think before, is that there's an exposure draft to remove the effective dates for all of the PCC-issued ASUs. They all allow early adoption. So rather than say, gee, am I doing early adoption? Do I have to do the steps that relate to that? There's an exposure draft that will probably be voted affirmatively that will just merely remove the effective dates for all the PCC-issued ASUs because they're elective in the first place. They don't apply to everybody. Even the private business has to volitionally elect it. There's a big exposure draft that's caused a lot of stir related to nonprofits and healthcare entities. Some folks, for example, have been really in a fuss over this. We think the fuss is premature, a little early to fuss, kind of like fussing about leases in 2008. Time to fuss about leases is 2016. The exposure draft would profoundly change the reporting for nonprofit entities. And in their words, enhance the usefulness of the statement of cash flows. The means of enhancing the usefulness of the statement of cash flows is doing what the FASB wanted in the first place with FASB 95, where they said that the direct method should be used and the indirect method is an alternative, but a less desirable alternative. They didn't realize that none of us were ever going to use the direct method. And maybe this is the FASB's revenge for the lack of use of the direct method. But there's been an inordinate amount of pushback, including a kind of an objection letter from the AICPA and other very weighty bodies that I think will cause the any standard that's issued to have a very different look from this first exposure draft. So if you're in the nonprofit or healthcare arena, keep your eye on this, but I would not overreact to it at this point in time because it's likely to be a moving target. So now here's one that was foiled, and I'm going to have to go to my notes on this because it's the lease exposure draft. The lease exposure draft has been out there since 2010, re-exposed in May 2013. Consensus was reached between the FASB and the IASB in May of this year, and they have a list of what they had agreed upon, tentatively agreed upon, and agreed to disagree. And that's what I used to build my presentation. Well, the FASB voted yesterday to go ahead and do this. So they voted yesterday to move with the issuance of this new leasing standard update to be drafted now, to be issued sometime, hopefully in early 2016, with the following applicability dates. So this is a change to the notes. So for public companies, this pronouncement will be applicable for periods beginning after December 15, 2018. For private companies, for years beginning, or periods beginning, fiscal periods beginning after 12/15/19. So calendar 2020 for most private reporters, calendar 2021 for most fiscal, or fiscal 2021 for most fiscal private reporters. And I think really what changed there is they put a longer adoption time than I have in the slides that we'll see in a few minutes. So wanted to correct that since they just voted on that yesterday. And do look for that statement coming forward. But remember why this happened. People were upset. Users were upset with the whole concept of off-balance sheet financing. Off-balance sheet financing, of course, was very, very important in many industries. If you used a bunch of rail cars, you might want to do them under operating leases. The leasing companies became masters at reverse engineering the lease terms to back into operating lease treatment on financial statements. And while I never thought it was that hard because you had the lease commitments sitting in the footnotes anyway, the user community really wanted a better approach to leases. So everybody agreed upon that. And once they drafted the exposure draft, it's kind of like everybody wanting change, but nobody agrees what that change should look like. Then there was the hullabaloo that lasted for really several years. So there were a lot of differing opinions on approaches, differing opinions on what should be included and excluded, but recognize that the pronouncement that will be coming out in all indications will be applicable to everybody. There will be few, if any, entity types that will be excluded. Oftentimes, nonprofits are excluded. They're in here. Oftentimes, governmental entities are excluded. They're in here. Oftentimes, companies under a certain size will be excluded. They're in here. And the long and short of it is that lessees would recognize assets and liabilities for a right-of-use concept. The definition of a lease is exceedingly simple. It's something that someone could probably make up in the 8th grade without ever having an accounting class. The definition of a lease in professional literature, I'm going to paraphrase it after I told you how simple it was, is it's a contract that conveys the right to use an asset from one party to another for consideration. That's pretty straightforward. But now with the right of use, now you have a number of nuances that took them several years to iron out. Right of use also implies control. So I just said this applies to everybody, every entity type. There'll be exclusions based on the nature of the contract. The nature of the contract is based on control. And control does not exist if the provider, the so-called lessor, has the right and the incentive to substitute the asset. If Margie is leasing that chair from me and I have the right during the lease period to switch it with Tim's chair, then it's not really a lease contract under the new standard. So Type B leases will be what we all know and love, remember as operating leases, insignificant consumption of leased asset. They're going to keep these simple. Not quite as simple as people had hoped. There will still be a right of use, but there will be a nice, simple amortization of that. One of the things that hung up this for several years was kind of a consensus on how to handle the discount rates and the amortization rates. So it includes most real estate leases because we're not consuming the building when you lease 10% of the office space for 5 years or 10 years or 15 years. And things will be straight line. Straight line is easy. Straight line has less room for judgment. All the fun will be on the capital lease side, where consumption of a portion of the asset occurs. Now we move away from ownership transfer, the default financing arrangement, which was the whole capital lease concept, and we move to a concept of consumption of a material portion of the asset. So think of what this means. Most auto leases now will not be able to be reverse engineered to be the Type B leases. They will fall under this category because even the gentlest of drivers for a period of years materially consumes a component of the related asset. So it's really going to push a lot more things into the more detailed treatment, which was, again, the initial motivation. The lessees report the amortization of the asset separately from the interest. We really separate the asset side and the liability side. The non-financial asset is measured at cost less amortization. It's a neat thing about the discount rate. The liability discount rate should be really the lesser of the implicit rate or the incremental borrowing rate. Well, the implicit rate is also to include the origination cost. Any origination cost, very similar to Erika's comment on deferred financing cost, will be built into the interest rate now, baked in. So they are becoming very consistent across these pronouncements. And I think that you mentioned the auto leases, this would impact most equipment leases in addition to vehicle leases and many leases for facilities where a meaningful amount of consumption occurs. I was going to talk about the fact that the statement's likely soon, and I was predicting 2018-ish for applicability. We've corrected that already, 2019, 2020, and we know it's going to be issued in the springtime. So that was the talk on the lease side. Erika is now going to lead us through the other biggie on the horizon, which is revenue recognition.
All right, so I have limited time here to get through what is a 700-page long ASU. If you go to the FASB's website, you can see it in all of its glory. This is commonly called the Revenue Recognition Standard. And it has a pretty broad application. It's supposed to be comprehensive, applying to all entities which enter into customers with, or contracts with their customers. Also, it should be noted this supersedes the revenue recognition guidance that is currently housed in Topic 605. Topic 605 is going to go away completely. We now have Topic 606 in its place. There's also industry-specific revenue recognition guidance that is sprinkled throughout the codification. Most of this is being superseded as well and will be housed again in Topic 606. This slide is showing some of the goals that the FASB had when drafting this ASU 2014-09. And they all sound pretty good. Remove inconsistencies, improve comparability, especially because so much of revenue recognition was industry-driven. They're trying to do away with that. And also provide more useful information. That all sounds good. It's just going to take a little while to be able to get to that point, which is why we've been given such a long period in order to consider what's happening and think about how to implement it in the best way. This next slide shows the underlying principle behind revenue recognition, and there's a lot there. Rather than reading it out loud, I think I'm just going to go ahead to the next slide, where the 5-step revenue recognition model is laid out. You'll see the 5 steps laid out here on this slide, but I'm going to go ahead and just move right into step 1. So in step 1, you identify the contract or the contracts you have with a customer. So just want to note here that the FASB's definition of a contract is very similar to what you would have learned in your business law class or in law school relating to what a contract is. Another important principle to talk about here is that in general, individual contracts should be accounted for separately under this standard. However, there is a portfolio approach that is allowed for if you have numerous contracts with different customers, but these all have similar characteristics. So a common example given here would be the telecommunications industry, where you have a Verizon, a Comcast that has thousands, countless numbers of customers and contracts with each individual one. There's also some judgment involved relating to if you enter into 2 different contracts with the same customer at the same time. Is that one contract? Is it more than one contract? And typically, the more interrelated those 2 contracts are, the more likely they'll be accounted for as one contract. Contract modifications are also considered here, and I think the term that should be considered the most on this slide is the idea of judgment. There's still going to be judgment involved with this new revenue recognition standard, and sometimes even in this step 1, determining do I even have a contract or not. Okay, moving on to step 2. This is where separate performance obligations within the contract are identified. So the term performance obligation is really used throughout this standard, so it's something that you should get used to. The current guidance would include a term such as an element, maybe a deliverable, a component, and that's really what they're getting at here. So the main principle I want you to think about for this slide is the principle of being distinct. So a performance obligation is a promise to transfer either a good or service that is distinct or a series of distinct goods and services. So there are 2 criteria laid out, I believe, in your handouts for what makes a good or a service distinct. First of all, it's capable of being distinct. Second of all, it's distinct within the context of the contract. So that might seem very conceptual, very maybe hypothetical, so I'm going to provide an example right now that hopefully will help. So if you take the example of a contract to build a corporate office building, this contract might include things such as engineering, site preparation, procurement, construction. So the main question you would try to answer is, are these 4 separate performance obligations, or is this really just one performance obligation? So looking at the 2 criteria that I just mentioned, first of all, are they capable of being distinct? So I think the answer here would be yes, because really a customer could use different vendors for all 4 of those things. So within that criteria seems to satisfy that. However, the second criteria, within the context of the contract, are these 4 things distinct? The answer to that is no, and as a result, you would just have one performance obligation in my contract example. Step number 3 is determining the transaction price or the amount of consideration that you would expect to receive. There are some special things that could happen here that require some judgment. And one of the most important ones is variable consideration. So some contracts are written very straightforward and the price is set in stone, easy to determine. Other times there are certain conditions that could change that price. Some common examples would be discounts, refunds, performance bonuses, etc. So what the FASB is having you do as a vendor, as the seller, is actually estimate the contract price. There are a couple of methods that you're able to use to estimate the consideration that you think that you will ultimately receive. One of these is the expected value method. It's probability weighted. And the more options that are out there, the more likely that this method would be chosen. And there's also something called the most likely amount method where you just say, okay, this is the one that I think it's going to be. Just to keep in mind that in general, this is going to result in more revenue being recognized sooner. Because under current GAAP, it's asking you, wait until that variability is completely resolved, then recognize revenue. Whereas this is saying, go ahead and estimate. You have to be informed, use informed estimates, but that is an option laid out for you there. There may also be a significant financing component to the time value of money, which should ultimately adjust the transaction price and would impact what kind of revenue you're recognizing. The statement says that interest revenue or interest expense should be recognized separately from the contract price. Non-cash consideration should be estimated at fair value. And if consideration is payable back to a customer, I would treat that as a reduction of revenue as opposed to an expense. All right, step 4, allocation of the transaction price, which we've just talked about, to the performance obligations, which I had touched on in step 2. The main thing to keep in mind here, the main principle I want you to consider is that standalone selling price. So that is what you want to use to allocate that consideration across the various performance obligations. Sometimes standalone selling prices are observable. Maybe there's a price list, a master price list, which you can consult. Other times there's not, and there are a few methods for estimation that are provided in the guidance for that. And then finally, moving on to step 5, revenue should be recognized when or as the entity satisfies a performance obligation. So the principle to keep in mind here is the principle of control. Satisfaction of a performance obligation means transferring control of that good or service to the customer. Now, this could happen at a point in time or over time. So I'll focus the remaining part of my discussion on the over time. So what needs to happen in that type of situation is that revenue should be recognized as you measure your progress toward meeting that goal, toward meeting that performance obligation. And you're able to use output or input methods in order to estimate your progress. So some output methods would be the milestones you've reached, the number of goods you've produced or goods you've delivered. And the most common internal input method would be costs you've incurred to date relative to your total costs, and you can recognize revenue progressively through that. And as circumstances change over time, progress measures should be updated, and these are accounted for as a change in accounting estimate.
Well, thanks, Erika. As Erika walked through the 5 steps for revenue recognition, we'll talk about a couple of the things before focusing on the transition and moving toward a break. It's important to remember that there are other elements beyond the 5 steps. What do we do with the contract acquisition costs? Contract acquisition costs, like lease acquisition costs and other items, if they have value for more than 1 year, can be capitalized if they directly relate to the contract. So a lot of the contract acquisition costs that we're used to seeing capitalized will still be capitalized. Some of the changes relate to those contract acquisition costs that are now covered by other statements. Lease acquisition cost treatment will be modified by the forthcoming lease pronouncement. You'll see that in some other areas as well. So you always want to make sure that you pay attention to the interaction with the other standards, and the literature is obviously very helpful in that regard. The disclosure requirements are, as Erika mentioned, designed to be helpful to the financial statement users to understand the nature and the amount, the timing, and uncertainties related to the revenue cycle. The disclosures under this new ASU or newer ASU really require relatively extensive qualitative and quantitative disclosures. So it's pretty important to be aware of that. So going forward, it's time to start paying attention to it. Start looking at the transition guidance for your industry, talk to your GYF advisor, other experts in the area, and start adopting it. Now we will look to a break until 10:25. And don't forget the prize bin that Mary Lou had mentioned outside the doors too. Thank you very much.
Thank you.